Hello, everyone. Happy Monday, September 9th, and hope everybody's doing well. We have a special guest going to join us today, talk about a very important subject that I think we can. I actually talked to a lady about this morning. I think it's a subject and a topic that a lot of our seniors, well, don't necessarily have to be seniors, but probably more towards that, can possibly benefit from. And it's one more tool that we have in our bag that if we're in a situation, we can offer our clients. So just tell you a little bit about me. Appreciate it. We still have more people joining as we go. My name is Kevin Ristow. I'm one of the vice presidents here at North American Insurance Services out of Frisco, Texas, which is our main office. I live in Grand Prairie, Texas. I've been with North American now 11 years. I've been helping Andy with the life division of our company for probably 4 years now. We've been trying different things, and we've really got some good momentum going. And every 2 weeks we have this call, and I try to have different guests on so we can just really share different topics. So we always have a person, depending on anything they're looking for, to refer to, whether it's reverse mortgage or a life insurance or anything else. And even if we don't have a relationship with someone, I think it's good to know that there are people out there that can help with anything that we need, because this time of year, depending on what you do, whether you're doing Medicare, health insurance, life insurance, doesn't matter what we're doing, we're going to run into situations where people might ask us, hey, retirement's not going quite the way I thought. Do you know anybody that could possibly help me with some ideas with that? Or do you know somebody that knows anything about Medicare? Do you know anybody that knows anything about long-term care? I learned long ago that if I'm not appointed to do those things, and I'm appointed to do mostly all of the different insurance things now, but there's certain things I'm not, like property and casualty. If someone needed, homeowners insurance or auto insurance or whatever, but I have plenty of people I can refer them to. If I have somebody that has a business and they want a particular type of liability or whatever, I can refer them to someone now. And then our guest today is him and I got to know each other through a networking group, and one of the groups we're in anyway. And you just make so many contacts that there's really nothing a client can ask you anymore that you shouldn't be able to point in a direction. And they appreciate that. If you can't do it yourself, they really appreciate the fact that you can point them in the right direction. You look like a fountain of knowledge that way. That just happened to me last Friday. I had two people that were asking me about, one person was asking me about renter's insurance. One person was asking me about auto insurance. And then I had another client, actually three people. She's moving to Virginia, and she was asking me if I knew anybody that could help with insurance in Virginia. So I got in touch with one of my contacts here out of Fort Worth, and they helped two of the people, and the other person is going to contact someone in Virginia to help that person. So they really appreciate you saving them time and effort. So I am going to share my contact information at the end. If you're currently with North American with our email group and all that, just email Kevin Ristow. Or I'll leave my email information and contact information if you ever want to call me. But I'm here to help you guys, whatever you need with. If I can't help you, I can have someone that can. I can help you with anything from life insurance, which is really what I'd like to help you with, whether it's term, whether it's final expense, whether it's IULs, whether it's whatever that has anything at all to do with life insurance, carriers, appointments, products, training stuff. I also, the other thing I do, I really enjoy is Medicare. So I'm getting geared up for that. And anything else that you need, if I can't help, I'll steer you in the direction of someone in our FMO that can, including Andy Daster, which is the president. Him and I have, we have been together for 11 years now. So I know the cool thing about having a president of a company, he's one of the biggest personal producers we have, which is very uncommon in our industry. And he's always accessible if you want to talk to him directly, as long as he can fit you in on his calendar appointment schedule. So with that being said, our special guest today is, and I had him about a month or two ago. His name is Michael Standard. He is an expert in the reverse mortgage business. And it's something that I know a little bit about, but I didn't know a lot about. And then Michael and I have spent some time together. I can tell he's an expert. No, I'm not, because the more he tells me that, the more I learn. But I still have to learn just like anyone else about it. But it is a key topic, and it's really, really beneficial for us to understand this, because we're going to be involved with so many situations, especially with the selling seasons coming up, that we might find ourselves in a situation where a person's dropping hints about what we're about to talk to. And I would say, hey, I just had training on that, and I know a guy, the famous I know a guy type thing. So with that being said, I see Michael with us. I appreciate you taking time, Michael, out of your busy schedule to join us on a Monday after Pittsburgh Steelers' glorious victory yesterday. So that's another good thing for me. So I am about to share the screen, and I'm going to let you take it away. Are you ready?
Yeah. Can you let me be presenter?
Yeah, absolutely. Yep.
My share's off.
Okay. Oh, it is. I got you. All right.
Still off. It says only meeting organizers and presenters can share. So you need to make me a presenter, I think. And I know these things are a pain, but while Kevin's doing that, happy Monday, everybody. In 2016, I basically left the brokerage industry, financial advisor and all that other fun stuff, because thank you, Kevin, I saw a real niche. And the niche was, gosh, there are so many people out there who have no idea. Here we go.
Are you good?
I think I am. Let me see if it comes up.
Okay.
Tell me if you guys can see it. Yep.
Getting there.
Slideshow?
Yep, there you go. All right, take it away.
All right. So this isn't too complex, but it's complex enough. So let me go slow. Turn on your mics, ask questions. So in 2017, they changed all the rules on this loan. This is no longer called a reverse mortgage. It's called a HECM, home equity conversion mortgage. It allows seniors to use their debt equity in their home to meet their financial plan, or to use their debt equity in their home for whatever else they want. It's their money to use, okay? But as you know, 88% of seniors want to age in place, but none of them have planned. Really, a lot of them don't have the money to plan for it. So that's why we're talking to you. 95% of seniors want to pass their home to their kids. 38% of seniors lose their homes to Medicaid. As you know, that makes you spend down to $2,000. In the great state of Texas, they give you $75 a month. Your spouse gets the rest when you pass away. And when the spouse passes away, you sell the house to pay off the nursing care. Okay, that's how that works. And 40% of seniors have to sell their house to go in a nursing care facility. So that's an asset that's no longer in their estate. We want to help them preserve that asset. And they've changed a whole bunch of rules here on this loans to help you do that. So here's just a shot of what the nursing home was charging on average in 2016. Now it's actually higher. I don't have a new slide. It's right around 106. Okay. 106 grand. And remember, over 50% of these customers of yours need long-term care insurance, and 95% of people do not have long-term care insurance. And now, as you know, there is a short-term care insurance policy that's medical that will work as well. So something to put in your little bag of tricks. I was presented that product, and I thought, what a great product. You know, $200 a month on average to get $500 of care per day. That's a good deal. So something to think about. So we know that seniors running out of money. We know that the inflation is eating away at their issues at their money and assets. Just about everybody I've talked to who's a senior has a large amount of credit card debt. And it's not fun. and they're not going to dig out of that hole at 19 and 23% interest, right? So we need to help them. So let me go over what changed in 2017. And again, please stop me if you have questions. So in 2016, when Trump got in office, he put Ben Carson as the head of Housing and Urban Development, better known as HUD. And when he was in charge, Ben said, look, this loan is broken. We need to fix this. So his exact words, so seniors can age in place by using their equity in their home and not going on to Medicaid, because Medicaid eventually just takes the home. So pretty scary thought when you can use this to age in place and you don't know about it. But are you guys aware that there's $14.58 trillion, that's with a T, $trillion of equity in seniors' homes just sitting there? For what reason? I don't know. So you as financial planners and insurance agents, this is going to hopefully open up the opportunity for you to talk with them. And I'll give you, if you want, a sales guide that helps you through the process, a little sales tool. But let me explain to you what happened in 2017. They kicked all the banks out of this product. There's no banks allowed. Wells Fargo, Bank of America, PNC, KeyBank, they all did this product and they sold it, and they wouldn't adjust interest rates and they wouldn't let them refinance, and they let them take out 80% of their value. So of course the homes are upside down. So the bank takes over in the end. That doesn't happen anymore. Okay. They kicked all the banks out. FHA wants the seniors to use their equity wisely and to age in place, because Medicaid's broke. How do I know? Well, I live in Dallas-Fort Worth, Texas area, and I was looking on the HUD website. So when HUD gets the home from somebody who's on Medicaid, they sell it on their auction website. So in North Richland Hills, there was a home listed for $431,000. Now that auction website on HUD is truly an auction website. That home went for $278,000. That's all they got for it. So FHA and HUD lose money when seniors' homes have to be sold because of Medicaid. Okay. So now it's equity based on age, which means at 62, that's the magic age, they can use this loan to access part of their equity. They'll get about 38% of their equity. That's sometimes enough to knock out their mortgage, so they don't have a mortgage payment. Freeing up those dollars can help you invest those dollars. So we're going to find more premium dollars, basically. Okay. FHA enforced insurance on this loan. It's 2% of the appraised value. It makes it a non-recourse loan, which is a fancy word for if it's ever upside down and you sell it, the government eats the loss. The government insures it for loss in case. Now, you have to be 62 or older. You have to live in an FHA qualified home. Cannot be a trailer in a trailer park. Must be on your own property. You have to live in the home at least 6 months out of the year, which means it has to be your primary residence wherever you're paying taxes. And any income out of it does not affect your Social Security or Medicare benefits unless you're on Medicaid, and then they limit you to $2,000. Okay. So 62 is the magic age, must be a primary residence. They keep title to their home. So there's a lot of myths going around out there, and you've heard of the myth of Sasquatch, right? Well, here's a funny story. I was born and raised 75 miles from where they took that video of Sasquatch. So that was up in the Northwest. And it truly was a scam. And I thought it was pretty funny that people still believe in it and still go hunt for Bigfoot, or Sasquatch. But this allows hopefully all these myths are going to be broken. So when you talk to somebody, you can give them the facts. They keep title of their home. We qualify them on their Social Security income. They can use this to do a purchase as well, which is good for you guys. But they never make a monthly payment. They don't have to make a mortgage payment once they have this. So they keep title. It's insured. They never make a monthly payment unless they want to. They just have to pay their property taxes and homeowners insurance and occupy their home as their primary residence. What happens now when they're required to sell it, or when they want to sell it? So when they want to sell it, they're never required to, except upon death. But when they want to, there's no penalties. They just pay off the loan that FHA gave them. So when their kids inherit the home, which is guaranteed, as long as you're paying your property taxes and the city doesn't, or county doesn't take your home back, this allows your kids to inherit the home there's usually a lot of equity left. So the kids have 12 months to sell it, or refinance it and keep it. They just pay off the lien and it's their equity or it's their home. So again, really safe now. It's insured. You keep title, no mortgage payments. And once your kids inherit the home, they keep the equity.
Can I ask a question?
Yes, sir.
Okay, so if we have a person that we think could benefit from this program, the equity in the home, does that mean that's how much left they owe on the home and this would pay it off? And then whatever the difference is between the equity and what they owe on it, they would get, and that's the money they would have, and that's why the house is paid off. They don't have a mortgage payment, and then.
Correct.
Okay, gotcha. All right. That's the part. I was just trying to connect those 2 points. Gotcha.
And most of the time, they have to have 60% equity. As interest rates come down, maybe it'll be
Okay.
55% equity. But it'll knock out the mortgage. Now they can use their houses if it's paid off as well. They have access to more equity then.
Right. Okay.
Now this is an estate planning tool. And if you're a CFP, certified financial planner, this is part of your software. So it allows us to put Medicaid in third lien position. It reduces the community spouse resource allowance, reduces the equity in the home on title so that they don't attach it or don't make them sell it. And you can use this equity in this cash for whatever they need for their financial plan. I've had clients, here's a story for you, and it was pretty interesting. I got a call from a realtor. So I met with this guy. He didn't want to sell his home. His kids wanted him to sell his home after mom passed away. She was in the nursing care facility for about 2 years, drained his savings, and he had basically nothing left except for Social Security income. And so he did not want to move. He wanted to stay. And so what we did was we did this home equity conversion mortgage for him. He had access to $120,000. That was his. He took 100 of it and bought a life insurance policy with a long-term care rider. So his kids get something, right? And he can now age in place with in-home care. And he kept the other $20,000 in the line of credit. There's a money market feature in these loans where the money sets. And it grows to whatever the current interest rates are, which are 7% right now for that money market account. Now, let me show you why this is an interesting, these umbrellas are here. A regular mortgage, basically Medicaid can say you have a mortgage or the bank can foreclose on you, but you have access to your equity. In this situation, when there's a FHA mortgage or this home equity conversion mortgage, it's based on the life expectancy of each person in the home. So if there's a $200,000 loan, it looks like a $400,000 lien. So because they base it on their life expectancy. So if you had a $200,000 lien on your home, it looks like $400,000 because of your life expectancy. So then Medicaid looks at the house and says, whoops, there's no equity. Move on to the next one. So they can still use Medicaid if they have to. But let's get past that. We want them to use their equity to age in place or to invest. This helps you find more premium dollars. So when you do this loan, you can take out a lump sum. You have a line of credit where they can take out money as they need it, or they can even set it up and annuitize it. Okay, does that make sense? So when you have a lot of equity in your home, or here's another example, guys. If you'd like to help them sell their house because maybe it's too big for them, they can't take care of it, you're meeting with them and you see that the carpeting's just ruined and the house needs painted and they can't keep up with any of it because they don't have the funds. Well, they could sell their house and use this loan, home equity conversion mortgage purchase program, to purchase a house. They only have to put 50% down. So they can move into that cute little community of 55 and over with the pickleball and the swimming pool and their yards taken care of. And they can buy that $500,000 home with a $254,000 down payment in this example, again, based on age. Now they have $246,000 sitting in the bank account. What would they do with that? I don't know. You're the financial planner. I bet you could think of some things that they said they needed, right? So that's important. You have access when they sell the home to a large lump sum to also help them invest and do the right thing with. So here's an example of somebody who's just using their line of credit. She's 81. She has a $355,000 home, she's estimated property value. Her principal limit, or the money she has access to, is $170,000. Okay, they take out their fees, that's their insurance fee. This is the origination fee. That's always showed as maximum. That's really not what it is. And then title and tax fees. So she has $152,000 available to her. 84,000 of it she has the first year, and the rest of it sits in the line of credit. Okay. So it can all sit in the line of credit and earn income as needed, which is helpful. Okay. So just as an example, there's always lots of money left in this. So if we go down to the 10th year, this lady's 92 years of age, you go to the far right, we're showing only an expected appreciation value of 4% on the home. Now, on average, it's 8% in the nation. Even in Texas, it's about 8% year over year. So in 10 years, the kids, in this example, the house would be worth $525 at 4% appreciation value. Kids still get $487,000. A lot of money left over. Now, if we use the 8%, that's $1 million home. They're going to get almost $1 million. Okay, because she doesn't have a very big loan. Off to the next. So this was a fun one. I had a client who we did a reverse purchase with, and her son started to argue with her after the fact. And I said, take him to the amortization page and again, show him that if the house only appreciates at 4% and we were never able to reduce the interest rate, stayed at 6.26, he would still have $465,000 left, even if the house only appreciated at 4%. Now, the house appreciates the regular 8%, which where she lives, it's about 10. That'd be a $2 million house. The kid would get almost $1.5 million. Lots of equity left. Okay. And I was meeting with her financial advisor at the same time, and he said that insurance fee is ridiculous. I think the insurance fee was $13,500, just 2% of whatever the house appraises for. And I said, yeah, it's a lot, but why don't we get a real life insurance policy? So if I do a regular loan for her, in 10 years, she's going to need $400,000 for her kids to be able to pay off the rest of the loan. He said, sure. I said, well, go get Lafayette Life, which is the cheapest one, he didn't know I was a past financial advisor, but I said, go get Lafayette Life to run your quote for $400,000. You can see it's $326,000 out of pocket, lump sum, because she's over 70. And I said, which is cheaper? And of course, he laughed and said, oh, the 13.5. I said, yeah, it's a lot cheaper in this situation. So don't think it's expensive. Don't think there's extra fees. They're all relative to what we're doing. Okay. This is not a loan of last resort. This is a financial planning tool. So anybody you know who's over 62, who wants to pass their home to their kids, would like to have more money in savings or like to fulfill that financial plan that you have for them, this is something to look at. Okay. I'm going to get this other piece up for you guys. Tell me if you can see this. Can you see these green words? Kevin, can you see that?
It says 2 questions to ask a senior.
Nope, sorry. You are sharing. I need to reshare. Give me a second. Can you see that one there? Nope, not yet.
No, same.
Give me a second.
Okay.
Okay. I'm going to stop sharing and start sharing again.
Okay. Yeah, if anybody on the call has questions, of course, go ahead and shout them out. Because yeah, like I said, after learning how the stuff really works, it's much different than I just assumed how it works. So could have a lot of potential people out there could benefit, and they would really appreciate us sharing this with them. Yeah, I can see it now. It looks like a bracket.
Okay. So this was designed by an insurance agent I know who uses this bracket, and it's very helpful. Now, some of the terms here are going to change, and you can cross them out and put in your own. If you'd like one of these forms, just raise your hand or put your information in, give it to Kevin, I'll send this off to you. So you've sat down and done your financial plan with this client, and you realize that they need long-term care or short-term care insurance, or maybe they need an annuity because they need more monthly income. and they don't have money. So you put in here annuity in this box. You need an annuity, and here's how much money you're going to need to put in this annuity. Let's say it's $100,000 to meet their $900 after-tax need for income. And so, pretty simple. You can say, okay, well, if you don't do anything, what's going to happen is you'll probably sell your home to nursing care to get into the nursing care facility, or you're going to lose your home to Medicaid. Because that's a fact of life. Because when the stuff hits the fan, it's not a 5-gallon bucket, it's a 55-gallon drum, because on average, a heart attack and any surgery is about $500,000. Cancer, any major cancer is over $500,000 in medical bills. And you guys know, if you do Medicare, they still owe 20%. So this is a way to help you find premium dollars to invest in the products they need. So you can now take them to the other box. You can say, okay, you need a home equity conversion mortgage. Maybe we're going to get one with a long-term care rider on it for you too. But you'll get, if you do this annuity, you'll get monthly income. Your beneficiaries will get the rest and remaining of the product. If you have a life insurance policy with a long-term care rider, you can point at this. Now you can afford in-home care in your own house, because wouldn't you like to eat out of your own refrigerator and use your own bathroom? Yeah, who wouldn't, right? The home goes to your kids, and there's more money in your budget now. So really simple bracket here for you guys to use to help them. Now you can go over here to the left and say, if you don't do this, in order, who's going to receive the home? Well, it'll be Medicaid if you don't have enough money. The nursing home, because you're going to have to sell it to pay for your nursing care. The bank, your kids will get what's left over. Now, if you use the home equity conversion mortgage, yes to long-term care, yes to planning, who receives the home now? Well, the kids get the home if there's a home equity conversion mortgage and the remaining equity. They pay off FHA, they keep the remaining equity, and Medicaid is put in third lien position. So we're helping them use their debt equity to find premium dollars to invest in the products that they know they need. Okay. And you can go through this with them. You keep title of your home. There's no mortgage payments required. Kids get the home and the remaining equity. It's insured for a loss if home is upside down. You must pay your property taxes, homeowners insurance, and keep the home in good repair. Why is that? Well, because if you don't pay your property taxes, the county is going to take your house. Not FHA, the county. Okay. And I just require some information here, date of birth, because it's based on age, their address, we can figure out what it appraised for, their loan amount, and you can email it to me or you can text it to me here. But this gives you a tool to use with your clients to help them do what they should do and find more premium dollars, because the best thing you can leave to your children and your heirs is life insurance. And if you can combine a long-term care rider on that, so they have access to long-term care payments, and they don't have to worry about selling their house and losing that asset, good for you, good for them. So that is that. I'll open it up to any questions, guys. Please feel free.
Michael, would you mind also, while we're waiting to see if there's any questions, can you, I just did the same, put your contact information, unless you have it at the end in the chat box.
Yep.
And plus, guys, this is being recorded. So if you want a copy, let me know. Or when Michael puts his information in, then, well, yeah, he's got it right there. I'm sorry, I didn't even see that. He's got it at the bottom of his form, actually. Yeah, get in touch with them. And Michael, you're licensed in how many states?
I'm licensed in Oregon, Washington, and Texas.
Okay. Yeah, and I'm sure if there was a situation in another state, if you were to talk to Michael, like I do sometimes, if there's a case, I just add another state and I'm up to like 30, 31 now.
And I can help you find, exactly, I can help you find other people. Okay. And something else that's really important, guys, I'm not just a mortgage broker, right? I come from the financial planning industry, just like you, and I'm a wholesale lender. So that means this, my company is called Hero Loans, Home Equity Retirement Option Loans, LLC. And I work also with first responders and all those great people. But the interesting part is that I do this wholesale, which means my fees are tons less than regular retail. tons less than banks. I'm cheaper than a bank because I go directly to the mill, so to speak, instead of going to Home Depot. Okay.
Yeah, so I appreciate, if you guys don't want to ask a question in front of the group, so to say, yeah, just go ahead and text, or not text, shoot me or Michael, an email or contact us directly by phone. We could definitely have a one-on-one conversation. If you want to pass the information to me, I'll pass it to him. But I wanted Michael on here for the main reason was just so we know that if we run into a situation with a senior or 62 or over, which I'm coming up on that, so that's not a senior, but I mean, if they have a really nice house and they own it or have a ton of equity, but they're cash poor, which sometimes it can fool you when you go up in front of a beautiful house and they got cars and pools and all these other things, doesn't mean they own all that. Could mean they're cash poor. Uh, and this might be something to just at least bring up if they drop hints that they may need help in a situation like this. So it's always good
Yeah.
to have a referral and someone that knows what they're doing. So, cool.
And
Anything else you want to add?
yeah, Kevin, something else. Here's a great story. So I was working with a couple through a Medicare agent, and she had owned the house for about 10 years. House probably appraised for about $400,000. And they just needed some things done. They needed painting done, they needed their driveway fixed, it caved in, they couldn't use it, and a couple other items. And they did that. They did the loan, they paid off some credit cards, they paid off their high interest products, and they were able then to have about $46,000 left. In the first year, she had about $180,000, which was hers. So she had $46,000 left. And she gives me a call. She chats with me, texts me. She said, my husband, he's been bleeding internally. We don't know what's wrong. His mom had colon cancer, and he was really afraid that that was the case. He had it too. And she said, Michael, we wouldn't have done this loan at the right this time. It was just God's divine providence. Now we have the money. We don't have to put it on our credit cards to pay for all these extra procedures he's going through to figure out what the problem is. They still haven't figured out the problem. It's not in his colon, it's someplace else. But
And another thing, I'm not, I don't want to interrupt you, but another
Go
thing
for it.
while you're telling this story is that we can't overlook is the fact that on top of all of that, they don't have a mortgage payment anymore.
Right.
And they have the extra money. That's a big deal. Really
Yeah.
big deal.
And she's sick. I mean, she's not well. So she can't get any long-term care insurance, neither can he. They both have a lot of medical issues. So they're stuck basically with using their equity for whatever expenses. But what a great opportunity to help a great couple. And it was because of an insurance agent who referred them to me that we were able to help them, put them in a better position. So if you guys have clients like that, introduce me to them. I'll see if we can help them. And then I'll always keep you in the loop as to what's going on and how it works and where we're at in the process. Just another one just today, they have a IRS lien on their home, $42,000. They have some major legal bills that are piling up because they're fighting a contract dispute. And now these are smart people. These are not dummies. They're very smart business owners, and they're using the equity in their house to do this because they're both over 62. They're fighting the good fight. They're paying off the tax lien. They're paying their lawyers to get this through so they can win. And if they didn't, they get a HELOC and have payments which they can't afford. So this allows them not to have payments, allows you to loosen up the premium dollars to invest in things they need. Hey, Kevin, I can't put my contact information in the chat. I apologize every time I click on it. It doesn't let me do it. But I'll just send you another email, but you can reach me, guys, at 360-690-5278 or Michael at Hero Loans LLC. Text me, it's easier.
Can you get back? Can you pull up that last slide you had again? Yep. Is it too much of a pain? Because your information, I didn't notice the left. Yeah, it's right at the bottom. Easy. Okay.
Yep.
And
give me a second. Here we are.
Hey, there you go. Perfect.
Yep.
In fact, I think I'll do the same. Hold on a minute. But just one more connection for all of us guys, so we don't have to leave stuff on the table. And if you could refer someone, say you go to a house, and I'm thinking of a couple right now. I told Michael about this case. They're in their 90s. One's 92, one's 91. They had long-term care. They got rid of it in their mid-80s. They never thought they would need it. Now the guy he's got Alzheimer's, bad. They have a limited income. They do have equity in their home, but they don't have money for long-term care now. They couldn't go into a place unless they sold their house, which they don't want to do. They, of course, can't afford long-term care, and even if they could, they wouldn't qualify based on health. So this is a type of situation where if we find ourselves in, we can say, hey, have you ever thought of this? This will give them an opportunity to have money maybe for a nurse to come in, home health care. Maybe they don't have the money to buy a life policy for themselves that they want to leave to their kids for a legacy, but now they can. So there's so many reasons to keep our ears and eyes open when we're out in the field with our clients that we could benefit them in different ways. So
Yeah,
that's,
absolutely.
yeah, I mean, that's what I'm learning. The more I hear Michael talk about this type of thing, it's awesome. So, hey, I appreciate everyone being on the call. We'll have the same call with possibly a different guest or just me training on life insurance 2 weeks from now, 2 o'clock. You'll get the invite. Always feel free to bring a guest, or if you ever want to recommend someone that can be on the call as a speaker as well, talking about something else. I mean, doesn't matter. It doesn't have to be life insurance or health insurance related. I mean, there's so many different things that could benefit us and our clients, benefit us out there. So, Michael, thanks for being on. I'll talk to
You
you
bet,
soon.
Kevin.
Everybody have a great day.
Thank you.
You're more than welcome.